Managing directors heading various verticals and managing directors of our subsidiaries are seated in the first row of the hall. We are also joined by the chief general managers of different verticals, business groups. To carry forward the proceedings, I request Chairman Sir to give a brief summary of the bank's Q2 FY24 performance and the strategic initiatives undertaken. We shall thereafter straight away go to the questions and answers session. However, before I hand it over to the Chairman, Sir, I would like to read out the Safe Harbor Statement. Certain statements in these slides are forward-looking statements. These statements are based on management's current expectations and are subject to uncertainty and changes in circumstances. Actual outcomes may differ materially from those included in these statements due to a variety of factors. Thank you. Now I would request Chairman, Sir, to make his opening remarks.
Thank you very much. Good evening, friends. Thank you for joining this analyst meet post announcement of Q2 financial year 24 results of the bank. Let me first and foremost start with a brief description of the present global economic scenario. Global growth remains weighed down by tight financial conditions, uncertainty about the policy trajectory, high debt distress, and geopolitical tensions, which have been further accentuated by the conflict in Middle East. Labor markets in major advanced economies continue to remain tight, prompting central banks to maintain higher for longer stance. The International Monetary Fund, in its October 23 update of the World Economic Outlook, kept the global growth forecast unchanged at 3% in the year 2023, same as in its July 23 update. Growth in 24 is, however, projected to moderate to 2.9%, as a stronger than expected momentum in the US is likely to be more than offset by a weaker than expected growth in the euro area and China. Against this backdrop, the outlook for domestic activity is brightening on account of the sustained buoyancy in services, consumer and business optimism, public spending on infrastructure, and the underlying strength of the financial sector's balance sheet, even as corporations deleverage and post strong bottom lines. Consumer confidence has improved with uptick in most of the macroeconomic conditions. Overall, credit ratio of ICRA assigned ratings was 2.0 in April-August 23, indicating improved credit quality of India Inc. Rating upgrades were strong in the hotels, auto components, financials, and transport and infrastructure sector. Growth is expected to gain momentum through the rest of the year, especially from the impetus of festival spending. High-frequency indicators showing acceleration increase in quarter ending September 23. GST revenue remains robust as monthly GST threshold has now increased to 1.66 trillion in April-October 23 as compared to 1.5 trillion in financial year 23. On the external front, the current account deficit is modest with sufficient foreign exchange reserves, providing a strong buffer that is insulating the economy from global spillovers as well as from the slowdown in external demand. While recognizing global risk and the volatility in financial markets that they entail, real GDP's growth is expected at 6.5% in financial year 24. On the banking front, the bank credit growth remained strong in the first half of financial year 24 in tandem with the economic activity. Credit extended by the scheduled commercial banks rose by 19.3% YOY as on 6th of October 23, over and above the growth of 16.7% a year ago. As demand for credit continues, we expect credit and deposit may grow by 16 to 17% in 24. In the above economic backdrop, let me now highlight a few key aspects of the bank's performance in the half year and the second quarter of 24. I'm pleased to announce that we have posted quarterly net profit of 14,330 crores, which has increased by 8.03% YOY. Operating profit for the second quarter of financial year 24 is at 19,417 crores, which has moderated by about 8.07% YOY. ROA for the first half of financial year 24 stands at 1.10% and has improved by 34 basis points over the corresponding period last year. However, the ROA for the second quarter of financial year 24 has moderated by 3 basis points on YOY basis to 1.01. ROE for the first half of financial year 24 has improved by 649 basis points to 22.57% YOY, and perhaps it is the highest ROE in the industry. Most other core profitability metrics have also improved during the current year. Net interest income for the second quarter financial year 24 increased by 12.27% YOY on the back of improvement in yield and the continuing credit offtake. Domestic NIM for the first half of financial 24 is at 3.45% and it has increased by 6 basis points on a YOY basis. Domestic NIM for the second quarter of financial year 24 is at 3.43% and it has declined by 12 basis points YOY on account of increase in cost of deposit during the quarter. We expect NIMs to be stable around this level by the year end. Non-interest income has increased by 21.59% YOY, mainly due to increase in fee income by 10% and profit on sale of investment during the quarter. Operating expenses have increased by 34.60% YOY, mainly on account of additional provision made for the ensuing wage revision. Earlier, the provision for wage revision were made at the rate of 10% with effect from November 22, which we have now increased to 14% with backdated effect from November 22, due to which additional provision of 3,417 crores have been made in the second quarter. As a result, the operating profit has been impacted and has come down. On the business front, the credit growth has been robust across all segments. Domestic advances grew by 13.21%, mainly driven by SME advances, which grew by 22.75%, retail personal advances, which grew by 15.68%, and agri advances, which grew by 14.76%. Corporate segment advances grew only by 6.62%. Recently, there have been concerns on the growth of unsecured loan portfolio in the banking industry. However, I wish to state that Express Credit has been one of the safest product lines of the bank, as it is given to corporate salary account customers whose salaries are visible to us. Out of the total portfolio of Express Credit, nearly 82.6% of the customers are either employed in armed forces or are government employees, and nearly 12% are employed with reputed corporate, including public sector entities, etc. The portfolio of Express Credit stands at 3.2 trillion as on September 23, with a gross NPA ratio of 0.69%. It is actually constituting 25% of the total retail personal portfolio of 12.43 trillion. We also have a strong analytics-driven collection mechanism using contact centers for the pre-delinquency outbound voice recording calls and also loan account management system for calling by the branches. As a result, as I mentioned, that the gross NPA of the portfolio is only at 0.69%, indicating the resilience of the portfolio in terms of the asset quality. Under deposits, domestic deposit grew by 11.80%, driven by growth in current account deposits and term deposits. Savings bank deposits have shown a growth of 4.34% YOY. Our foreign offices have continued to perform well with the growth in advances of 8.11% YOY, as well as deposit at 14.57% YOY. Our foreign office advances have crossed an important milestone of 5 lakh crore. With regard to the asset quality, our gross NPA ratio has improved by 97 basis points YOY and stands at 2.55% and continues to be at its lowest level in more than 10 years. Our net NPA ratio has also improved by 16 basis points and stands at 0.64%. Slippage ratio for the first half of financial year 24 has improved by 16 basis points YOY and stands at 0.70%. The consistently improving asset quality is also reflected in our credit cost, which stands at 0.22% and it has improved by 6 basis points YOY. PCR including OCA improved by 39 basis points and stands at 91.93%. PCR for Q2 of financial year 24 has declined by 248 basis point to 75.45%. Herein, I would like to mention that our PCR for the corporate book has gone to 99.55%.
I apologize. Audience. Sorry. So to accommodate all the questions, we request you to restrict your questions to maximum 2 at a time. Also, kindly restrict your questions to the financial results only, and no questions to be asked about specific accounts, please. In case you have additional questions, the same can be asked at the end. We now proceed with the question and answer session. And the first question is from here. Can you?
Yeah, good evening, sir. Maruk from Novama. Sir, my first question is on margins. So, where do you expect margins to stabilize given that everyone has come up with aggressive festive offers, including festive deposit rates? So, where do you see domestic margins stabilizing for the next 2 to 3 quarters?
My expectation is that our margin should be around this level, or maybe it might see compression for another 3 to 5 basis points.
So, deposit cost has bottomed out, or
I expect the impact of the deposit cost only. And as far as the loan book is concerned, we have already offered the concession, whatever we had to offer. And we are seeing decent traction when it comes to our sourcing and underwriting is concerned. So I think we will have the impact of the increase in the deposit rates only. I expect that it will have an impact of another 3 to 5 basis points on the margins.
and the full MCLR impact is now already captured?
It is, yes, almost fully captured. Though we still have some elbow room for increasing the MCLR, but that will be very judicious.
Okay, sir. Sir, and my next question is on OPEX. So, say for every 1% increase in the wage agreement, what would be the sensitivity? So, if we provided 14% now, and if it settles at 15, what will be the additional cost?
Roughly about 100 crores.
100 crores per month. Okay.
No, not per month.
Yes, per month.
Per month, yes.
100 crore per month.
Additional one.
If you take 11 trailing months, it is 1100.
Okay. But so if you remove the 3.4 billion that you mentioned from this quarter, then do you expect, if rates remain stable as they are now, do you expect the provisions for wages to remain at the core level, or?
No. See, once all this backlog which you have to provide for, that will not be there. Then it will be actually, once the wage revision happens, then it is a wage bill only. No additional provisions. So roughly about 400 crore is something which we expect, if at all. That will be the increase in the wage bill
400 crore
for a quarter, per month.
per month. Okay.
Yeah.
Okay.
So
Thank
about
you.
1200 crore a quarter.
Okay, sir. Okay. Thank you, sir.
The next question is from. Can you please raise your hand?
Sushil Choksi, Indus Equity. Sir, based on current economic environment and specifically business in India, how are we seeing traction on large projects at SBI?
When it comes to our, we have got proposals in pipeline of about 3.4 trillion, and about 1.4 trillion would be which is awaiting, which are pending for disbursement. So about 4.8 trillion, 4.7, 4.8 trillion is that kind of a book. So I think with the kind of evolving situation, global situation, since all these projects are primarily going to cater to the domestic economy, I don't expect that it will have any significant impact. And because what we get to say in terms of the inflow of proposal, that is again the validation of what I am saying.
Sir, but your growth on SME and retail is quite sustainable and growing on a better pace. Will your growth not outnumber your projection?
See, we have been indicating that we'll be growing at about around in the range of 14%. And I would like to surprise the market on the higher side. That's why my suggestions or recommendations are always little conservative.
Sir, last week, in the current week, your business standard appearance and governor's speech and the Fed on Wednesday, the entire bond market globally is showing a different color than the concern. Middle East concern stays, but the bond market is clearly indicating that things may reverse where treasury and rates are concerned. What is your view? Have you changed your view post Wednesday, or you still?
See, I think these one-offs when we form a view, it is not based upon the one-off events. It is based upon multiple events which are happening across. Yes, of course, these are important events which needs to be factored, but I think if at all we have to have a view, we will have to probably wait and watch a little more in terms of how the global economic situation unfolds, and its likely impact, because Fed has said something, so, and also our RBI governor has also indicated something. But yes, of course, I think there are multiple other things which we have to keep in mind while having a view.
Thank you for answering my questions.
Can you please raise your hand? That's it.
Yeah, good evening, sir. Mahesh from Kotak. Just a few questions. One, if you could just kind of explain the movement of the balance sheet. There seems to be a bump up in investments this quarter, increase in borrowings. What explains, what have you been thinking on the balance sheet side?
No, investments have moved to about 17 trillion, and we have seen decent growth also. But when it comes to our credit deposit ratio on the domestic book fund, it is somewhere around 64%. We are very mindful in terms of underwriting the risk which is according to our risk appetite. And if at all, we don't want to get into any adventure. And that is one of the reasons why we are very conscious in terms of building up of our loan book. And also when I talk about that, I am very mindful in terms of the price at which we can lend. If at all the price does not offer us adequate risk return reward, then probably I would rather prefer to look into the investment book as compared to the loan book. So that is something which explains. Maybe you have something more to add?
Yeah, I think on the investment book, the growth has been 8.2%, quarter on quarter. It is mainly coming from the G6 and SDLs. So some of this liquidity what we normally have, as we keep saying that we have a policy of parking the excess liquidity in the SLR securities, and we have substantial excess SLR which helps us market borrowings. That's what you see, that on one hand investments are growing, as well as we also participate in any liquidity management what we need to do.
So the question pertains to the fact that you raised borrowings as well on the other side, which I assume is far more expensive. So I'm just trying to understand what were you thinking when you were...
You are talking about the market borrowings or the borrowings
Yeah.
in terms of the
borrowings
bonds?
in the balance sheet,
Yeah.
non-deposit related, the borrowings which is sitting there, that also has gone up by about 1 trillion, 1 lakh crores this quarter. But just trying to understand what have you been thinking on those two metrics, because you've raised deposits and borrowings and you've seen significant investments when your CD ratio is low. Just trying to understand what
No, I think, see, one thing is that we can't raise deposits when we need to fund the
Absolutely,
credit growth,
absolutely.
right? As Mr. Khara keeps saying, deposit is a franchise. We continue to raise the deposits. And when the deposits are raised, there are two alternatives. One is that you fund the credit growth, or alternatively you put in the investments. So, and whenever we put in the dated securities, obviously, those securities are used for raising any liquidity. That's where you see the borrowings also, the other side. I hope I'm...
Sure, I'll take it
clear on
offline.
that.
sir.
Yeah.
The
you can take it
second
offline.
question is on the provisioning line. Again, there's reversal on standard assets as well as other provisions. If you could just tell us what's happened in these two lines.
Yeah, we have been adopting a policy for past almost 2 years plus, where we have started providing for any kind of a likelihood of the stress which might emerge on our loan book. And that is something which you have, when we are sure that those stress are no more there in sight, we have reversed those provisions which we had created for the standard sets. That's about 1,200 odd crores.
Okay. And last question, sir. On the SME side, you've started seeing pretty good healthy growth in that. It's now clocking about 20%. What are you thinking on that particular portfolio?
See, I think somewhere in the year 20, we had given the guidance that we will try to move up in the SMA book from 3 trillion to 4 trillion. So we are somewhere there, only 3.88 trillion, we are already there. By 24 we had indicated. So I think we should be in a position to reach out to this level, and this growth has been built up in a very, very clear and conscious manner and into the identifiable products which are in line with our risk appetite. So that is something which we have done, and we feel that we should be in a position to sustain this kind of a growth trajectory going forward, having built up our infrastructure relating to SME lending. We have significantly beefed up our infrastructure for SME lending. We have improved the loan management system. We have brought in the algorithm relating to the lending to SME. We have introduced a new product, pre-approved business loan, where we are witnessing almost about 1,800 kind of a growth every quarter. So this is something, these are some of the initiatives which we have done, and that 1,000 pre-approved business loan is all analytics driven, depending upon our understanding of the customer and their transactions. So I think we have taken multiple such steps which will help us in ramping up our SME book.
Thanks, sir. Just to clarify, the yields on the SME loans is similar to the Express Credit? If I were to just compare these two products?
It should be slightly lower, but I think it is slightly lower.
Okay.
But then, of course, it continues to be a much better yielding product considering the fact that these days some of the banks are willing to lend to some of the corporates at less than the STL rate also.
Okay. Done. Thanks.
Sir, Prakhar here from Jefferies. Sir.
Yeah, please, sir.
Congratulations, sir. Very good set of numbers, especially in the backdrop. Sir, just wanted to get some more clarity on the funding cost part. I just wanted to know, is it possible to give some sense on what percentage of your term deposits have actually moved to the new rates? Because for the last couple of months, banks have not raised term deposits materially. So probably the incremental rate has been set. Where are we from that on the P&L side?
Even we have not also increased the interest rate for quite
Yes.
some time. But whatever repricing has happened, I think perhaps it will all be fully panned out by the next quarter, whatever little is left out.
Okay. Okay. Understood. And despite that, the margins will hold up. So just wanted
That's
to
the
get
reason why I was saying that maybe we might see compression of another 3 to 5 basis point.
So if I may just ask, sir, where is the offset in your view coming? Is it mostly the LDR, or we are yet to see some repricing on the loan side? Because
I think LDR will be the one. We expect to improve the LDR, and that will help us in shoring up the repricing of loan, whatever will come now for the renewal at this stage. MCLR based loans, which will come for the renewal now.
perfect. Thank you, sir.
Sir, so this is Nitin Agrawal from Motilal. So one question on the unsecured piece of the book, like in the press meet you talked about that the trends on asset quality are going very strong on a personal loan book. But if I look at your subsidiary cards, they have been talking about some rise in stress levels. So how do you look at the divergence in these two segments of unsecured, and do you think that this gap will narrow?
See, the point is that subsidiary has got a very different underwriting principle, and the book is very different for them. As far as we are concerned, we are giving unsecured loans to those who are maintaining salary accounts with us. So we have got a very clear visibility in terms of the fund flow for such entities, such customers. And that is something which is helping us in terms of mitigating the risk in the unsecured book. When it comes to our subsidiary SBI card, they do look at some of the customers very independently, because that's a separate entity, and there are certain restrictions as far as RBI is concerned in terms of sharing the customer database with our entities also. And that is one of the reasons why almost about 50% of their book is something which comes from State Bank, and the remaining 50% is from the market. And as it is, when it comes to credit card business, that's on a very different line. It's an unsecured business. It's very high yielding business also. And to that extent, they have got a ability to absorb little higher delinquencies also, but their collection mechanisms are also very different as compared to what we really practice. So I think to that extent, it's a very different model which they follow. And the kind of model which we follow is very different. As we have low risk appetite, we have got much lesser yield on such book also, but nevertheless our delinquencies are well within control.
Right, sir. And sir, the other question is on the loan growth, wherein you are indicating for a 14% plus loan growth. And so how do you specifically look at the corporate growth and the international growth, wherein we have seen a good pickup this quarter? So these two segments, if you can share some color.
See, corporate loan, I expect, as I was sharing, that we have got the undisbursed portion of some of the sanctioned loans, unavailed limits of the term loans. In the term loans, we have seen the availment has improved by almost about 100 basis points in this quarter as compared to previous quarter. And also when it comes to the utilization of the working capital also, it has improved in this quarter. I think going forward, we will have a situation where this will probably availment will improve further, and also the part of the pipeline which is there for 3.4 trillion and odd, which is there for the proposals which are under process. We will get to see some sanctions getting converted into, some such proposals getting converted into sanctions, and some of them getting availed also. So I expect that this corporate growth should see some improvement going forward. Ideally, I would like to see it somewhere at least in the lower two-digit numbers.
Right, sir. And the international book?
International book, we will be somewhere around this number only. We don't want to go very aggressive on international book because different geographies are behaving differently, and that is the reason why we want to confine ourselves to some of the stable geographies like US and Middle East and Japan, where we have grown in this quarter also. If you recall, last quarter we had not grown in the international book. Essentially, we were trying to understand how the global situation is going to evolve. Now we have got some clarity, and with that in mind, we will be growing in these markets.
Right, sir. Thank you so much.
Thank you.
Yep. That side.
Yeah, hi sir. This is Jay Mundra from ICICI Securities. It's a question on your ROA, right? So for the last 2 quarters, we did 1.2% ROA. This quarter, we have done 1% ROA. And I can see that, this wage revision provision enhancement that we have done, 3,400 crores, this turns out to be around 24 basis point of an ROA pre-tax, right? So, of course, this is likely to be a one-off and unlikely to reoccur. So the question is, are you a 1.2% ROA bank or are you a 1% ROA bank? I mean, in the sense, so that is the question.
No, my effort is that it should be a 1.2% ROA. Our monitoring on ground, this is something which you are doing.
Right. And secondly, sir, when you say margins could decline by 3 to 5 basis points, this is domestic only or this is global? Because your overseas margin, have been at very, very high level and, could be more volatile versus domestic.
Actually, the overseas book, if you are at all, you will look at the interest rate trend overseas, that is all on the higher side now. So I think this 3 to 5 basis point compression in margin is essentially, I was looking at the domestic book only. But I think overseas, I expect that we should be in a position to maintain these kind of margins in the overseas book, at least in the foreseeable future.
Thank you, sir. All the best.
Hello, sir. Hardik here from Goldman. Congratulations on good set of numbers. My first question is on the competitive intensity in the mortgages. How is it and how do you expect it to trend going forward?
This market is quite competitive. There is no doubt about it. But when we look at our sanctions and disbursements, we are seeing healthy trend. As high as about 20% or increase. 25% increase on a sequential basis. So I think we will continue to see that kind of a traction because we have invested well in terms of our ability to source, process, disburse, and also control and follow up. So last year we added almost about 150 CPCs across the country. So this is something which is going to really work well, I think. And we expect that we will have decent growth in this going forward.
Okay, and sir, second question is on the SME book. Can you give some more color around what is the average ticket size? What are the sectors that you are lending to within SME?
Please.
So see, in case of SME, we have grown almost by 57% in working capital, which essentially means that the units which were sanctioned loans, they're utilizing more and more working capital because of enhanced scale of operations or demand fulfillment also. In case of term loan, we have grown by around 25%. But the growth also comes from supply chain finance, where we have grown by almost 29.44%. Growth is also coming from the CGTM SME loans, because in CGTM SME loans also we have improved our processes, and that is leading to growth. And the best part in this entire SME transformation is that we have around, say, 2,000 relationship managers spread across almost all the districts of the country. Wherever you have SME concentration, there are almost 900 branches which are essentially doing SME, nothing else. Of course, the related SME work may be current account and some of the forex business. And the processing cells, we have two types of processing cells even in many places. One processing cell is entirely for all kinds of loans which will come, and one processing cell has also been specifically, established only for the supply chain business. And we went into some transformation known as Project Pratham, which also led to a lot of BREs, business rule engines, getting established. So I think both on the product side as well as process, plus use of the different partners, fintech partners, etc. This is all leading to growth. And the most important point is what the chairman has said, that he has mandated 4 trillion kind of SME growth. So which has electrified the entire workforce in the country to do this SME business, because you understand that SME has been our business since times immemorial, and we need to have a rightful place in the entire SME ecosystem of the country. Hope it satisfies.
And what would be the utilization levels in those working capital which has enhanced the growth?
It's utilization levels only in SME space. Another, because the SME loans would be SME loans would be generally up to 50 crores, because more than 50 crores SME loans, as we classify in our portfolio, is very little. So there, we don't have that kind of data that for 20 crore loan or 15 crore loan, what is the utilization. That utilization percentages we generally monitor for the corporate credit loans, where we have around 56% kind of utilization in the corporate loans.
Okay, got it. Thank you, sir.
So my question again is related to SME, but not on the growth front. I just want to understand any signs of stress that you see in the SME segment. How are the NPAs trending in the Mudra and the non-Mudra loans specifically?
You see, in case of SME, we have done analysis to find that the SME NPA is mostly a function of less than 50 lakh. 50 lakh loans is basically the section which gives the highest, more than 70% of the NPA. So there, as most of these SME borrowers would be micro kind of borrowers, so they are exposed to more kind of vagaries of the market. As such, we find that they may be prone to stress many times, but we also see that many of them get pulled back. Like if you see the slippages of last quarter, almost 1,200 crore of slippages has been pulled back. So it's a